All right, Rick, mate, thanks for joining us for the Adansonia Quarterly discussion.
Rob, always my pleasure. Thank you for having me.
Now, we can't often say that markets are boring, but we definitely cannot say that at the moment.
No, look, markets, especially over the last quarter, have had a bit of everything at the moment, and I think it's also just a good time to touch on what we've done with the portfolio, where we've actually raised cash over the quarter. So we sold some shares and reduced exposures in others, and we went from about 3% cash to about 43% cash. And happy to sort of chat about the reasoning behind that.
Yep. No, that sounds good, mate. So obviously, that is a fair cash holding, and it's a level that I would suggest you haven't seen for quite some time. So I'd be interested to hear more about your thoughts on the positioning.
Happy to expand on that. So yes, look, it's right. I mean, look, we certainly have sort of reduced exposure to the market, and I think that's as a result of a few things. So look, pretty much what we've seen over the quarter, and even prior to the quarter, is that the market's pricing in a lower risk world. I mean, equity indices are bouncing off near record highs, but the fact of the matter is that you've still got ongoing issues in Iran with the US, etc., like that. Oil prices are starting to peak, or there's volatility in oil, I should say. But obviously, what we've seen is that President Trump looks like he's lost control of the war in Iran. Also, on the back of that, Rob, we're also seeing that bond yields are following oil prices up, and the market basically, looked through that. The yield curve, or the two-year yield curve, was definitely pricing in more than one rate hike, and the Federal Reserve basically held rates. And interesting to see that the market sold off very strongly on the back of that, on the absence of a rate hike, sort of signaling that they believe that the US may be, or the Reserve Bank, the Fed, might be losing the fight against inflation. On top of that, too, the market to us, being fundamental investors, just started to make less and less sense, Rob, in the sense that AI, drove markets for a fair few years, and now we're just sort of seeing that the market is having difficulty pricing or understanding the impact of AI moving forward, and we're seeing that certain sectors are falling in and out of favor. So you see semiconductor stocks rallying, and then sort of the funds move from that into memory stocks, and then we've had the software stocks, which were basically on the nose for a long time, rallying very strongly. And of late, the hyperscalers have now started to basically perform very strongly. And I've spoken about holding a Microsoft before, which was a larger holding, and it was pretty much sin binned for since the beginning of the year for no good reason that we could see. But the fact of the matter is that things from a fundamental perspective seem to be breaking down for us a little bit. Also, importantly, insider buying of shares. So, CEOs, we saw more selling than buying of late. So when you put all of that in perspective, and also just the way that fund flows are driving markets at the moment. Again, we've spoken about it before in terms of more than 85% of equity flows are into ETFs and structured products, passive products, which are driving shares more as a function of their size than their fundamental value. We just sort of thought it's best to step back a little bit. I mean, obviously we're looking to redeploy that cash, but we're sort of thinking the market is near topping out. And that just these signals that, we've had very strong earnings reports for some of our shares, at least, through the last quarter, which really didn't move the shares. So that to us was just a little bit of a signal that we're near the top. Also, in the monthly report, which I did, which I point people to, we found a great chart, an indicator chart. Actually, Buffett uses this one as well, which looks at the Wilshire 5000, or the value of the broad-based US equity market as a function of, or as a ratio of, the value of the US economy, US GDP. And it's at a 55-year high. So from 1970, it's never been higher in terms of the equity market versus the value of the US economy. It's trading about 200% or 2 times. In saying that, it's probably a bit unfair because there's an adjustment needed for multinationals. Obviously, it's not just the US economy. But in saying that, even when you, I don't know, take 4 trillion out of like a 32 trillion sort of US GDP number, and adjust that for the value of the equity market, it's still at a record high. So all of these things in concert sort of thought to us, sort of made us say, look, just time to step back. Also, SpaceX is something which we spoke about, where you had shares like Microsoft trading on 16 times, delivering strong results, and the market basically slapping management down for basically being a growth stock and reinvesting, retained earnings into Azure or into cloud and AI services that were capacity constrained, and the stock basically, being down for the year. And you see SpaceX, which is an AI and rocket company that's basically hemorrhaging cash, with a lot of money to spend, rally from a subscription price of 135 to 225, I think, and then collapsed to like 105. It, to us, just sort of thought to myself, we just sort of start to think the market's becoming a casino and just time to step back. So we're doing a lot of work at the moment now where to redeploy cash. We've still basically, got good exposure to stocks which are performing very well at the moment. But things just broke down for us a little bit, Rob, and we just sort of thought to ourselves, you know what, just step back and start with a clean piece of paper. And that's what we've done.
Yeah, no, it's yeah. I mean, we've been talking about a lot of these things for quite some time. So I suppose it reached that point, and SpaceX definitely had that feel to me of, that classic, that point in the cycle where you go, that was the top. It was just insanity.
On the back of that, you've seen obviously, some other big potential IPOs that have been sort of shelved, like Anthropic, etc., like that. So
yeah.
Yeah, so as I said, look, a lot's to shake out. And saying that, the reporting season has been very strong of late. Obviously, Microsoft and Amazon had absolutely blowout results, but if you sort of normalize for that, it's still been a very good reporting season. We're about halfway through the second quarter season, and so far, yeah, the market's been delivering, but there's a lot priced in.
Yeah. And so just when we're looking at that tug of war, so we mentioned obviously interest rates increasing. Now that's interest rates increasing is obviously a dampener on stocks because, well, you can get a higher return and arguably less risk. So how are you sort of viewing that tug of war? Because yields have been going up for quite some time around the world. How are you sort of seeing, I guess, the valuations in the bond market as relative to the equity markets as a whole, understanding that you're an individual stock picker? And I guess, are you sort of foreseeing that, we may be getting some flows leaving the equity market to say, lock in sort of, these higher interest rates by investors?
Yeah, definitely, potentially. So, look, I mean, I guess what we're doing, look, we're fundamental investors, so we value every stock that we use. So we use a multi-stage DCF and use a long-term interest rate that's higher than what's prevailing. So again, you're right. I mean, moving forward, we believe that rates will go up. I mean, the fact of the matter is that inflation is proving to be stickier, and that is going to basically impact on equity values moving forward. As you say, it's all about opportunity cost. So we're already factoring that into our thinking, Rob. And in saying that, the long story short is that I don't think that any one particular sector in the equity market is going to be a clear winner. I think it's a stock picker's market, and you've got to basically pick the eyes out of what's available. And case in point, I mean, just going back to, again, the cloud companies. So the three major cloud companies, obviously Amazon, which is a retail company, Microsoft, which is a software company, and Alphabet, which is a telco. So, I mean, in the end, it's all over the place. So I think in saying that, one clear one clear winner sector is going to basically, I don't think it's going to present itself. Also, we're looking a lot at gold at the moment, something that we haven't had in the portfolio. But the fact of the matter is that we believe that the only way that the central banks are going to get the level of indebtedness out of under control is that it's going to have to be inflated away. So, there'll probably be a bit of inflation or high level inflation, but not to the point that it's going to basically tank economies.
Hyperinflation.
Yeah, hyperinflation. That'll be a positive thing. And look, as you say, in all of that, with higher rates, we might actually go through a period where we have positive real yields for the first time in quite a while, which obviously, as you said, will be good for the bond market and basically figure into people's asset allocation decisions. So again, with the stocks that we look at being being the growth manager, we don't sort of have a lot of cyclical exposure, which is obviously going to be more impacted by higher and lower rates. Obviously, higher rates are not great for high PE stocks, but again, I think that we're moving into a market where you're picking companies on their merit, on their fundamentals, on their I guess their enunciated business plans, their ability to deliver those business plans, and the management. And this is the silly thing too, just sort of jumping around a little bit. I'm sorry about that. One thing which really sort of surprised us, and getting back to like the hyperscalers like Amazon and in particular Microsoft, is that when you buy a company, you're buying the management. And for us, that we were always scratching our heads because sort of saying there's nobody closer to the coalface of these companies than the management. And in terms of these stocks were put in the wilderness for their high level of spend on building out AI infrastructure. And but in the end, investors, equity analysts, whatever, believe they knew more than management, and they sin bin these companies, and obviously management has now delivered very strongly. So we've seen very big bounces in these companies. I'm sure a lot of it's also going to be short covering, but as I sort of said, just things have been breaking down a little bit. But you're right. I think the outlook for bonds with short duration yields, short duration bonds, I should say, is I think quite favourable because I think that rates will rise in the US, and that will basically impact on markets.
So, Rick, just on one of the other things that I've sort of been noticing about this, the AI and the CapEx spend and what have you, like previously it has been done from cash flow,
Yep.
right? So there has been, these companies have been making stacks of cash and they've been reinvesting it. The thing that's become really apparent over the last little bit and moving forward is that it's predominantly going to be done from debt.
Yeah.
What's your thoughts on that change of positioning for these businesses? Yeah, notwithstanding the fact that we've already spoken about interest rates potentially going up, but just that change from, spending cash that you're generating as opposed to borrowing new cash, and what does that mean to these companies and potentially the valuations of them?
A great comment, Rob. Well, look, I mean, the fact is that what sort of was one of the main catalysts for the last results for Microsoft and Amazon is that they're now starting to see that that returns are being generated from the equity being sunk or invested. So with these companies, it's not a case of build it and it will come. It's build it because we need it now. So you're right. I mean, they have been basically funding capex from debt. And in saying that, like case of Alphabet, Alphabet's got $250 billion of cash and cash equivalents. It still paid a 22-cent dividend, and it got sold down, I think, 7% after result because the capex was a bit higher than expected. So look, it's certainly not going to sink their balance sheets, and these companies, in terms of the level of operating cash flow that they're generating, is huge. I can't remember off the top of my head, so we look at a lot of companies, but I think the EBIT margin for Microsoft is over 20%. Just the earnings growth on the back of what's being generated. I mean, I think revenues for these companies were up like 20%. Earnings, EPS, was up 30%, and the growth in cloud, in AWS and and in Israel was 40%. So they are, if you look at it at a point in time, yes, but the fact of the matter is that they're getting the returns on what they're investing on the investment, and that was the biggest fear that the market had. So yes, it's a large number. I can't remember the aggregate number. I think for all of them, I think a couple of $100 billion. But the fact of the matter is that the investment is starting to already deliver a return and generate cash and generate earnings, and that's basically what quelled a lot of the market fears. Yeah, that's the thing.
What about the impact of China? So obviously, being in the West automatically assumes that they're the brightest, they're the best, and they're going to win.
Yeah.
A lot's been said regarding China and its rise in this space, and even though I think it's broadly agreed that they're not quite to the level of the Americans yet, in regards to cost, they're a fraction, like 10% of the cost that the US guys can deliver. What's your thoughts on that, and how will that impact it?
There are a couple of things there, Rob. Firstly, I guess the national interest issues, or just corporate governance issues, in the sense that having a Chinese-made AI model in a large US corporate, or basically in a US government department. I mean, there are issues around security there. So you question that. Yes, you're right. Also, they are generating with the new models. They are generating models which are very functional. For a fraction of the price. You know what? The companies, the hyperscalers themselves, are doing the same. So Microsoft is generating its own models through MAI, and they're seeing that. So I guess there's been a lot of fear around all of this with respect to NVIDIA, because NVIDIA is sort of like at the cutting edge, and they've got they generate the chips for the I guess most high powered learning models. But you pay for them, and then the fear is, obviously, or the question is, well, if the cheaper alternatives, what does that mean moving forward? What you're seeing with a lot of these companies is that it's a mixture of everything. So, firstly, NVIDIA, which isn't in the portfolio, it pretty much democratizes AI. It's ubiquitous on all the platforms, all the hyperscalers. Even though they're basically generating their own chips, they're still using NVIDIA chips. NVIDIA is also basically in applications from robotics to autonomous vehicles. It's in open models as well, and it basically will probably lead to the next generation of models being generated moving forward. But on top of that, you're still seeing the likes of Microsoft, etc., generating their own models, which are cheaper models. NVIDIA's models are the high-powered GPUs, are probably being used more in AI learning situations, whereas with the in-house models, they're being used for applications which don't require the same level of compute power, but obviously it's a lower level of spend also that you're paying for. Also, on top of that, what we've seen, and Microsoft spoke about this very well, also just from a governance issue, it's very dangerous to have, I guess, all of your company data, all of your company IP, all of your company secrets, for terms of a better word, linked to one model only. So also what I think we're seeing, what we believe with a lot of Fortune 500 companies, is they will be using a variety of models from a variety of providers for specific uses or reasons moving forward. So it's a very fluid sort of situation at the moment, but basically what we believe is that you'll see a mixture of models and, I guess, chips being used across all of these companies at different platforms. Also, the fact of the matter is that the hyperscalers can't generate their own models and chips, fast enough to basically, satisfy the demand for their capacity at present. So there's a need for third-party models. But look, in saying all of that, the use of Chinese models within US corporates and potentially within US government departments, we believe that they're geopolitical / national security issues around all of that, and also obviously just governance issues. And also, we believe that there'll be a variety of models, used, from different suppliers in large companies, also for governance issues and basically being able to, I guess, get the capacity that you need right here and now. So, look, it's just an incredibly fluid environment at the moment, Rob, where I guess people are starting to focus more on the granularity or the nitty gritty of AI, and the market's sort of being very black and white. When you look at the software companies, AI is going to destroy every software company, and more considered debate now in terms of it's probably going to be a productivity enhancement than something that's going to replace an existing business. So obviously we're talking about in vertical SaaS models, as opposed to horizontal SaaS models.
So Rick, now that you've got a lot more cash and you're sort of having a look around and assessing other opportunities, is there any other sector or anything that looks exciting that probably 12 months ago you wouldn't have thought so? Is there anything out there that's slipping under the radar of investors that will provide the next opportunity?
I guess the main thing is, Rob, is like, some of these software companies, as I mentioned before. I mean, look, so we still own WiseTech. We own Intuit, but, Autodesk is one which we've been looking at, which is essentially an end-to-end sort of a solution for building and engineering. A lot of these software companies, SAP is another one. A lot of these companies have just been absolutely slaughtered, and even though there's been a very good bounce in them, they're trading still on very low multiples with a very strong outlook. As I mentioned, we're looking at gold. Outside of that, I think as I said, to put it down to a sector as such, as I mentioned before, I think it's really just on a case by case basis, and this is where we've got the screening tools, to basically pick companies, just purely for the criteria or merits that we're looking for, and then on the back of that, we do the bottom-up analysis to see what's priced and what can still be delivered. So, as I said, it's becoming very much a stock pickers market. We're still obviously very respectful of, I guess, how the market's being driven by flows. I mean, we still continue to scratch our heads looking at the likes of, Combank, which is the world's most expensive bank with no growth. That's still basically performing simply due to flows. But in saying that, we just don't think that will deliver, above market returns sustainably over the long term.
No, agree. Well, Rick, mate, thank you very much for taking the time to catch up with us and give us an update on what you're up to and how you position the portfolio. And we look forward to seeing what you're going to do with this cash that you've deployed and the opportunities that no doubt will pop up.
Thanks very much, Rob. Look, and sorry for jumping around. I realised that we sort of jumped all around in that conversation. But look, we are doing a lot of work. Also, just thank you again, to the dealer group for the continued support for our product. We very much appreciate it. And as I sort of said, look, we've got a lot of dry powder. So as opportunities present themselves, we'll definitely basically employ that cash.
Sounds good, Rick.
Great. Thanks very much, Rob.